Good morning, everybody, and welcome to the Marin Economic Briefing. My name is Mike Blakely, and I am the CEO of the Marin Economic Forum. We are a nonprofit public benefit organization here in Marin County focused on economic vitality. You can find out more about our work and access previous versions of these briefings and all kinds of other reports by visiting our website at www.marineconomicforum.org. So welcome to this morning's Marin Economic Briefings. These are our monthly series of information and data presentation to the Marin community. Today's program is going to focus on a couple of issues which you have no doubt been hearing about recently, including inflation and the difficulty of hiring in the labor market more broadly. With me to discuss these issues, as always, will be our Chief Economist, Rob Eiler. He's going to present some of the key data at the national, state, and of course the local level. And following Rob, I'll be happy to provide some analysis on where this organization sees the economy and notably some of the issues that we're dealing with in Marin and how we may be working around those going forward. We're always striving to make these programs beneficial to you, the community, and so we're always open to your ideas on content and format that might help. What we've done recently is invited people to raise questions in advance of the program that we can address. There are a couple of those today that we'll get through. But if you have other suggestions on how you think this can be more beneficial to you in understanding our economy, please feel free to contact us. So I'm going to turn it over to Rob, and he's going to take us through some data, and then I'll be back to wrap it up. Rob?
Thanks, Mike, and thanks everybody for coming today. Mike, can you see my slides?
Yep.
Awesome. So folks, I want to start with just a quick overview of the national and state economies as context for where we are in Marin County right now. The national economy has about 5.8% unemployment seasonally adjusted, but that represents about 5.65 million workers that are still out of work. And notice I have bolded there May 2019. We are now comparing to 2 years ago because to compare to May 2020 would look like there's this huge surge and forgets that we're trying to benchmark to a pre-COVID number. So keep that in mind when you start to see data. And I'll reflect on this when we talk about inflation in a minute. But when you start to see data going back, I think we're thinking of pre-COVID benchmark is the better play, not just year on year right now, because last year was so crazy. It's about 6.5% GDP or income growth forecasted for 2021, and then some moderate growth moving toward 2024. But a lot of that surge in 2021 is because of fiscal stimulus and remaining low interest rates. And that's driving some of the inflation issues. And we'll talk about that more in just a minute. For the California economy, jobs growth is trucking along, and the opening of the economy more completely in terms of sort of like, turning a fader on a light that's now getting brighter rather than just flipping a switch. We are now going to see this sort of gradual movement up toward probably the middle part of next year where we're going to feel like we've really gotten around the corner. We will see. This summer is going to tell a large story, especially in places like Los Angeles, where that metro area remains a drag on the state numbers overall. And we are seeing, however, there are some counties, including Napa County, that have gotten back to pre-COVID numbers in terms of total employment, believe it or not. And there was a really big pop in Napa County, at least in the data for May 2021. As we'll see in a minute for Marin County, and this is true generally, the leisure and hospitality industries, the other industries or the other services, which include hair salons, nail salons, and sort of uncategorized employers, still remain a drag and still have a lot of scarring, if you will, from the COVID-19 recession. And we're not completely out of the recession. The National Bureau of Economic Research has not declared the recession over yet, which means there's still some issues lingering enough to suggest that we're not completely clear of the shadow from last year. Now, one thing I'd like to show is this sort of recovery path. So I'm going to show it for California, where this is the Great Recession movement from the beginning of the recession. November 2007 is when we started to see job losses in California on a seasonally adjusted basis moving forward until we actually got back to that pre-Great Recession number about 70 months later. So that shows you this like nice long bowl effect, really showcases what happened in the Great Recession with respect to lost jobs. And this is where we are in COVID-19. So you can see it's much more of a V-shaped sort of modified V with that right leg flattened out a little bit, 93.6% back to that red dotted line, which is January 2020 for the COVID-19 recession. So for California, we've sort of seen some fits and starts of recovery. We feel like we're now trending a little bit more, and we're expecting that black line to move up toward the red dotted line more and more over the next 12 to 15 months. Mike talked about this right off the top. There's been a lot of discussion about inflation. And with this graph, as you'll see in a minute when I shade this area, we've seen a real surge in what we think of as personal consumption expenditures prices, or the deflator that basically converts nominal income, the cash in your pocket, to real income, what you really have in terms of purchasing power. And it's split into two pieces, total and core. Total is everything, the entire consumption basket, if you will. But core is everything minus food and energy prices. And food and energy prices tend to be more volatile than other goods and services. So that shaded area is what's got the news going crazy, and to a certain extent has had the bond markets very volatile, and also our stock market somewhat volatile over the last couple of months. But you can see that the total has gone up a little faster than the core, but they're all going simultaneously. Part of this, as you'll notice in the labeling, is a 12-month percentage change. If you look back to last year, where prices were dropping because demand was dropping against supply, we should expect a relatively good pop. If you look at the data that happened right after the Great Recession ended, we had somewhat similar movements in prices. The problem for right now is it just looks like it's skyrocketing, and that's got financial markets a little bit nervous. But folks, the bottom line is really on expectations. So it's not so much the current inflation rate as how we're expecting change. And expectations have remained relatively metered in that the Federal Reserve's done a really good job with sort of letting the economy know what's happening in such a way for people not to panic. We are seeing some sort of, refiguring of supply chains globally, and that also feeds into inflation movements, with the idea that if supply chains were somewhat constrained last year, and also you've got a lot of inventory sitting around because demand sagged, you're seeing goods and services providers trying to slowly put goods and services back on market in such a way to sort of maximize revenue, and that leads to some inflation, especially if demand is surging for multiple reasons. So a lot of what's happening in inflation is somewhat explained, but the key is whether or not this change is driving expectations in such a way that we're moving to a sort of a sustained level higher than normal, that sort of FOMC objective, or basically what the Federal Reserve is watching to think about what's going to happen with interest rates. That's where we're quote unquote normal. If we come back down toward that dotted line, we shouldn't expect any real financial market movements. But the Federal Reserve is signaling that 2023 is probably when they're going to start lifting interest rates up. We will see how those growth forecasts and also how global supply chains remain relatively stable to lead to that outcome. But this is really what's going on with inflation. It's a function of what happened last year, supply chains sort of getting back together against demand that's been surging for multiple good, positive reasons. But it's really an expectations. If our expectations remain relatively tethered to that black dotted line, we're going to see inflation somewhat moderate. Okay, let's talk about the local economy with respect to Marin County, with some comparisons both to the state and regionally. This is a similar graph that we saw for California. There is the movement in the Great Recession for Marin County. Took about 58 months for Marin County to go from the beginning of the Great Recession and the total amount of residential employment, people that live in Marin County that had a job, to get back to that same number. So almost 5 years worth of downturn to just get back to square. And this is where we are in terms of COVID-19 as of May 2021, about 92.7% back. Now, some of this is a labor force issue, which we'll talk about in just a minute. But as I said, it took about 58 months for the Great Recession to get back. And that 92.7% is for people that live in Marin County. So it's very much a function of the quote unquote labor force, or the folks that are either working or available to work that live in Marin County, not people that work in Marin County who may live some other place. They're counted in some other place's labor force. We need to get that black line back up to the red line, just like we saw with California. So the recovery momentum looks good, but we still need to grow a little bit more. If we look at a comparison to the state, what these data are telling us is sort of the headline news about the residents of Marin County. We're down about 5.2%, looking back toward May 2019. Remember, I told you that off the top. We got to be thinking pre-COVID, same month, to get the seasonality out of it, but also look at a benchmark that happened previous to COVID-19. About 5.2% down in the total number of people available for work or working that live in Marin County. Still about 10,000 workers that live in Marin County, down from where we were 2 years ago. So while the unemployment rate in Marin County is 4.3%, and that's kind of the headline, and we've heard a lot of headlines about how that's the best of the 58 counties in California, there's still some issues, because that number is really just a ratio of the total unemployed within the remaining labor force. If you've had people that have left the labor force, that number may be a little bit tricky to interpret against the number of jobs that are no longer there. That's why it's important to look at that negative 10,000 number is really the key indicator to the capacity of Marin County residents in terms of how much they're making from labor. California is down about 5.5% in terms of total employment, still about 1 million people down from where we were 2 years ago. So one of the things about recession, and this is why I compare it to the Great Recession above, is it does take time to recover. And that's an important piece. And that's why it's important to think about a benchmark previous to COVID-19 starting, not just 1 year ago, because 1 year ago, it was volatility downward and it looked like we'd have this amazing growth, which doesn't really tell the whole story. In terms of labor force dynamics, I kind of alluded to this. This is the evolution of the change in the labor force, thinking of what's happened over the last, let's say, 12 or 13 months. And you can see it's been slowly climbing after a real big dip in April 2020. So we start with when COVID-19 really hit us, April 2020, and we've been marching up ever since then. This is the change in the number of people that live in Marin County that are either looking for work or have a job. So that's gone down. Now, this is California. In California, because other places in California that aren't tied to the Bay Area or to a major urban area have had less volatility and has also seen people move to those areas, and they're now counted in somebody else's labor force. It's a little bit closer to that red dotted line, but notice the movements are very similar. And that's mainly because social policy has been general across the state and not necessarily localized. But here's the key. One, we have to remember these are the people that live in Marin County, not necessarily who all work in Marin County. We'll get back to the people that work in Marin County in just a minute. But there's a lot of debate about why we still have a lower labor force than when we started and where these workers are. Well, the four main reasons why people either leave the labor force, thus you get these negative numbers, or are just simply still living in Marin County but not necessarily looking for work is that A, they might retire. They may be looking at a career shift and seeking more education. And so this is why we think of higher education as a counter-cyclical service. They might have left the area, like I said earlier, and they're counted some other place. Or they choose to leave for discouragement or domestic needs. So one of the big stories we've had is that women have left the labor force and thus have left looking for work overtly because they've had to stay home for childcare. We know that that's happening. We've heard that from multiple angles in terms of surveys done by private research firms and also by the Federal Reserve. But we also know that there's something going on here with respect to unemployment insurance benefits. So there are multiple reasons why we still have a lower labor force than when we started, or when we had the labor force we had before COVID-19. And we should expect this to linger as long as these issues remain. So retirement is more of a long-term change in the local labor force. The other ones can be changed through the evolution of unemployment insurance benefits and basically economic recovery. Now let's shift and look at the employers in Marin County and the evolution from April 2020, the beginning of the recession, to May 2021, which is the latest data. There's the initial drop across these industries, and you can see that some of the industries didn't react immediately. Now there's May, so now we're starting to see more reactions. April was the first month. May was really, in fact, will be historically seen in California specifically, and Marin County is as a microcosm of California, saw more action across more industries in May 2020. But by December, we saw recovery kick in across most of these industries, not all, but across most. By April 2021, we've seen more recovery, and here's where we are in May. So it is a mix of positive and negative numbers where, let me just roll back real quick. May 2020, basically all negative except for farm. December 2020, most still negative, but by May 2021, we have a nice mix of positive and negative. But the negative numbers remind us that there's still some industrial scarring. The recession is not over. More specifically, this shaded area really highlights the employers that still have relatively lower labor demand and really just not the same number of workers, even if they're seeking those workers out, than before COVID-19. So 22.8%, almost 23 out of 100 jobs that were there May 2019, not there May 2021 in leisure and hospitality, which is the amalgam of bars, restaurants, hotels, and event centers. 16 out of 100 for other services, like I talked about before. Hair salons and nail salons are sort of the classics in that one. Education, health services down about 9%. Government down about 11%, which is primarily in state and local government. But the point is that we have seen recovery momentum. The context looks good. We just need to get through the summer and see what happens with those, let's say, lower wage, more personal service jobs under the assumption that as the economy opens up, we will see labor demand and supply start to match each other. So lifting those restrictions is key, and we will see how we recover, but everything looks good. It's just going to take time. And folks, that's really the number one thing about the forecast, is that it's going to take some time. So with that, I'll hand it back over to Mike.
Rob, thanks. Why don't you go back to that slide, because I'm going to ask a couple of questions there. And as is prone to happen in Zoom events, I'm getting a phone call right as the mic is turned over to me. So apologies to that. So there's a couple of things on this slide that are really interesting, and I think our audience would like to know. So first of all, let's all remember that where these higher numbers of job loss are also in the sectors where we have the highest number of jobs in Marin County. So that means that those sectors, it's not just the fact that they're slow to recover these jobs, but that's where a lot of our jobs are. And so it's sort of a double whammy when you look at those big numbers and understand that we're talking about big volumes of workers in those sectors. The second question on this one, Rob, is are these jobs that exist and are not being filled, or are these actually jobs that have gone away, as you said?
Mike, that's a $64 question. So the way to interpret these data are that they are jobs that existed May 2019, pre-COVID, same month, but have not yet been filled. Now, whether or not they are permanent structural losses in these industries, or are just basically recession scarring that ultimately will scar over and heal, is really one of the biggest policy questions moving forward. We're hoping that they are the latter, but if they're the former, then that would transform the local economy in ways that would change the amount of goods and services that are available locally.
Right. And then I guess the final question would be looking at the sectors that have gained jobs and those that still remain, with significant job losses. Or anything that surprises you in what you're seeing about here in Marin County?
Well, not really, in the sense that if you look at transportation, warehousing, and what should have said utilities, and I'm sorry that got eliminated on the labeling, that's up basically across the board. And that's because we've changed our lives toward a more home delivery model. And so we've seen logistics jobs rise up and really almost trading retail and other services and leisure and hospitality jobs for people that are driving goods to homes. So that's picked up. So there's nothing really going on there that's that shocking. The rest of this is pretty much following what's going on with the state. It's good to see construction and manufacturing either even or a little bit up. That shows you that our goods producing side is picked up. And that's somewhat an anomaly to Marin County having very concentrated construction and manufacturing versus the state overall. But all this is pretty much in line with what we expected for places that are basically suburban around the Bay Area.
Great. Okay, so a couple other questions now. When we look at the employment recovery comparison of with the Great Recession, and we note that in California, we've got about 93.6. In Marin County, it's 92.7. Both those figures have been stagnating to some extent over the past 2 months. Do you attribute that at all to the fact that jobs are open and people are not taking them, and thus the recovery of employment is slowing? Or is this really because people who are looking for that work can't find that work?
It's a combination, and unfortunately, Mike, we don't have a lot of precision in which one is which. We know that part of it is because unemployment insurance benefits remain augmented and extended, and that's giving some folks in those categories a little bit more pay than they might get otherwise by going back into a job. So under the assumption that those benefits fade over the next few months, we should see people now start to take jobs that are offered in those industries. But the other piece is just the movement of the labor force, and that's why I showed that earlier, is that we may just not have the same number of people available locally, and thus the job search time has increased versus the pre-COVID jobs market. So that might take, instead of landing somebody in 4 weeks, it might take 7 or 8 weeks. And that extension just moves that line moving toward that red dotted line more out, a longer time and a flatter movement toward recovery. So that's what happens. And this is also somewhat typical of post recession and early recovery, is that the job search market, if you will, has more friction in it or more problems in matching people that want work to jobs that are being offered. So we're still seeing some of that, at least for the time being, and probably will last another 12 or 15 months, by the way.
12 or 15 months. Okay, good to know. And then the last question, for those of us who watch these things, 6.5% projected growth. When's the last time we had such a high figure for projected growth?
Well, in terms of even in recovery from the Great Recession, there was really not a whole lot of quarters that had those kind of projections, and really annually, it's very tough to find forecasts that would have ever been so bold as to give those kind of percentage changes. But a lot of it's because we went down so far that now we're really seeing the recovery momentum pick up, and you should expect that kind of percentage bounce from starting from a smaller number. So some of it's just math, in that you start at a smaller number so you can get a little bigger percentage bounce. The other pieces, we've got so much stimulus happening, we kind of should expect those relatively large percentage changes. So it's been some time, and in fact, probably in the history of the United States, there's only about maybe 4 or 5 quarters or years that have had those kind of numbers forecasted, much less realized. So it is very robust, at least historically speaking. We'll see if it plays out.
Yeah, it's exciting. We'll see. Great. Okay, Rob, thanks for those. Those are the questions that we have. And if you don't mind switching down the next slide, I'm going to talk to everybody a little bit about how we are seeing things. So let's start with sort of the beginning of this pandemic, where the scenarios for the economy were extremely poor. And we were looking at a situation that might be significantly worse than what we had experienced in the Great Recession. So when we were looking at how deep would the recession go, how long would it take to recover, where is the impact going to be, all of the negative information was coming fast and hard, and we were very worried about the length of time it would take to recover from this. And over time, our sentiment has shifted significantly. So we first thought that the depths of this were going to be something like we hadn't seen since the Depression. Then as time moved on, we started to see that, well, some people aren't being affected as adversely as others. And if you'll recall, that's when we moved into this phase of the K-shaped recovery. So some of the population was doing very well, had managed to recover their jobs, save money, and was actually moving on an upward trajectory. Many others were not, and they had lost their job, they had gone into debt, they had burned through their savings, and were on this downward trajectory. Now, we've noticed here at MEF over the past month or so, we're starting to get a little more clarity on the longer term shakeout and impacts of this, and what that might mean, not only for recovery, but for going forward. So there's significant national factors that are at play everywhere, including here in Marin. So prices are up. We saw just yesterday that consumer prices for May of 2021 were up 5% across the board. That is higher than they have increased in a long time, as Rob would confirm. And what Rob, in the discussion of inflation, said what people are really looking at is, are these price increases going to sustain? And so there's good evidence that they're going to be around for a little while. Even the fact that, some of you may have heard lumber prices shot up and other commodities shot up. They're coming back down now, but we don't know that those spikes could continue or what the next commodity to get hit. Housing scarcity, of course, is something we know all too well here in the Bay Area, but now you're starting to see it in markets across the nation. And so it's not only that prices are up, but builders are not building as much inventory because the raw material prices are also up. So the housing scarcity is becoming a national issue right now, which is interesting from one perspective, because in Marin, we've been dealing with this for so long that you wonder if other people are how they're going to address these issues relative to, what we're trying to manage here in addressing a similar issue. Deliveries are taking long. We know about the supply chain issue. That is still an effect of factories having to shut down early on in this process. And so now that things are coming back online, people are going back to work, they're getting vaccinated, there still is a risk. I'm a mountain biker, and I imagine many others on the line also are cyclists. One of the major brands had to shut its biggest factory in Malaysia, because of a COVID outbreak that only affected 5 out of something like 500 workers. But they decided to shut down the factory for an entire month. So you can see that an extreme case like that is going to continue to disrupt supply chains and continue to be a risk. And then finally, we all, and we touched on this earlier, this idea of the scarcity of job seekers. We have right now 9.7 million jobs, which is more than we've ever had open. This, of course, if everybody who was looking for a job was able to take these specific jobs, then our unemployment issue would be over. But that's not how it works. As we all know, jobs are in different places, different pay ranges. There's all kinds of reasons why we have so many job openings now. Rob discussed some of them. That's probably going to continue. These issues here are not short-term issues. The second thing that we're looking at is how are people reacting? So we've always said, if you look at the Marin economy coming back from this, because of the way our economy is structured with our personal services and goods, small businesses here serving the resident population, we knew that consumer demand would always be a huge issue. And so we're seeing that play out right now. But the other major areas where people are starting to adapt, which is affecting this recovery, is again, on the job front. People are either quitting their jobs they have now and taking the summer to think through what they want to do or visit family. This is all well documented. But overall, if you start to read deeply into workforce trends and you start to look at surveys that poll especially younger professionals, you start to see that once again, we're at one of these phases where people are rethinking what a job really means and what kind of career they want. And they have the luxury to do that because everything is sort of stalled. Some people have saved money and been able to take time to think this through more thoroughly. But without a doubt, because of the positive experiences some people had with remote work and many other things that have come about over the last year, people are simply choosier in their job pursuit. And that is going to make it difficult on employers who pre-pandemic were already seeing heavy competition for talent. The other thing that is actually, what we would have expected and is coming to bear is the opening of new businesses. Typically, the new businesses are at their highest coming out of recessions. And so sure enough, the data is proving that. In fact, we're seeing record numbers in terms of new business creation. And a lot of this is concentrated in individuals pursuing sort of sole proprietorship or types of jobs that they could do as an individual, not just the gig economy, but things such as people who started a home-based business, right? The state of California has made it easier for people who want to do a home-based food business to do that. A lot of people have made that type of transition. So there's a lot of people that are launching businesses at a faster rate, and that's going to impact the labor force. So finally, let's look at how companies are changing. And, I saw a fascinating data point the other day that said something like 20% of corporate goods producers have rejiggered their formula of content to price in terms of their product. So you're seeing actually less square meters of paper towel in a roll. You're seeing less volume of cat food in a can. These sort of odd adjustments to try to deal with, I don't know if you call it price recovery or deal with keeping their prices at a price point that is not raising them too much. But this is something that I've never seen before. You're seeing employers recognizing that employees are becoming, as I said, choosier, wanting more out of the work experience. So they're having to totally, in some cases, rethink what an employee is and what kind of benefits and what types of workspaces they have. I mean, it's been a huge positive disruption from the perspective of employers trying to make sure that their work environments and the jobs themselves are more accommodating and rewarding. It's probably already well known that the pandemic has forced a lot of businesses to automate where they could, but because of the low cost of capital, you're also seeing significant investment back into business and back into automation in particular. And then another thing that is happened more and more, and this is going to play out, and we don't know the consequences of this, but you're starting to see more private investment into residential real estate. Which is going to affect not only the rental market, but of course the housing market, because it's very difficult for a first-time home buyer to compete against a corporate entity that is, cash flush and has basically made a point out of purchasing huge volumes of residential housing. Just yesterday, Blackstone, which is an investment group, announced a $6 billion purchase of a residential home buyer in order to move into that market. So you're talking about significant capital moving into that market. And some economists out there are concerned about one of the next things we experience being a rental crisis. That is, people not being able to afford to rent homes just because if it becomes an investment asset, then the dynamics change significantly from the mom and pop owner that it's a second or third home that they're trying to keep as an investment. So basically, business is responding to short-term problems with a long-term view. And so with that, this is sort of how we see things. We've gone a couple minutes over, but there's a lot happening out there, and we're starting to get a lot more clarity on what recovery is going to look like. And so I just want to finish by, of course, thanking everybody for being there. Please do continue to send us questions and provide your ideas on how these events can be more useful for you. Because we are in summer and because a lot of people are traveling, we're not going to have our next program until the month of August. But in between that time, I want to share some news for those who have not already heard about it. MEF has secured a grant from the Economic Development Administration. And in partnership with the County of Marin, we are going to be preparing an economic vitality strategic plan. So these issues that we're talking about today and have been talking about in these briefings are about to come front and center in terms of how we address them here in Marin County, and in particular, what it means for our economic future. So with that, I'm going to wish everybody a good remainder of your week. Thank you again for tuning in. Continue to spread the word and send us comments, and please enjoy the rest of your day. Thanks for tuning in.